Alright, on today's episode, we'll be looking at theory of costs. So when we say cost, we mean expenses. So when a firm is into production of goods or services, such a firm is saddled with the responsibility of determining the cost it incurs in the production of the goods or services. So basically, for a firm to determine the cost it incurs in the production of goods or services, such a firm will have to add all the costs that were incurred on the factors of production or on the resources that were employed into production. So basically, for a firm to produce, you need a service of labor, labor services. That's those that are going to help in the production of the goods. So be it factory workers or administrative workers, that's the office workers. So you need to pay labor uh, for those services which they render in the production of goods and services, and that's wages or salaries. You also need to pay rent as a firm, so for the land which you're using for production of goods. Then also capital. When you borrow money as a firm, you need to pay interest on that. An entrepreneur, those are basically supervisors, managers, and all that. You also need to pay them salaries and all that. So all those costs added together gives us the total cost of production. So to define cost now, cost simply means the expenses that is incurred in the production of goods or services. Now, like I did say earlier on, that cost could also mean expenses, and most times expenses could also mean expenditure. And when we say expenditure, expenditure can either be recurrent or capital expenditure. When we say recurrent expenditure, they usually come in form of administrative costs. That's paying wages, salaries, pension, gratuities, and all that, allowances, and all that. Those are basically recurrent expenditure. But when we say capital expenditure, those are expenditure that are usually expended on capital projects. And capital projects usually have a long lifespan. They are durable in nature. For example, building of roads, dams, street lights, building of schools, healthcare system, and all that. But that's basically uh, in the public sector. But also, when a firm makes the move in terms of investment by acquiring a building, is also a capital expenditure. So that's what we mean by expenses or expenditure. So another word for cost is expenses or expenditure. So in short, for a firm to determine its cost of production, such a firm will have to add all the costs that were incurred on the various factors of production employed into production. And don't forget also that uh, the total cost to an accountant differs from the way the economists view it. So the accountants view total costs or costs basically as only explicit costs. And explicit costs are those costs that are incurred on resources that are introduced into the business from outside. Let's say, cost of raw materials, cost of labor, cost of fuel, and all other resources that were introduced into the business from outside. The costs incurred on them are called explicit costs. So that's the view of the accountant in terms of what cost is. And with respect to the economists tend to see costs in a broader view. So they view cost as both explicit and implicit costs. And implicit costs are basically the resources that are introduced into the business by the owner of the business itself. That means the imputed resources of the owner of the business into the business. So most times we usually refer implicit cost as the opportunity forgone. So in terms of that, we could say the implicit rent, which is the building the owner ought to have rent house and get the rent. Implicit wages, the services the owner of the business renders to the business, which the owner of the business could have rendered to an outsider and collect wages or salary. So all those foregone costs which the owner ought to have received but did not receive it because it's rendering the services to its business. We term them as implicit costs. So addition of explicit and implicit costs gives total cost to the economist. So that's basically with respect to cost. So cost of production, I think that is understood basically. So let me strike a difference between short run costs and long run costs, because it's very important you all understand how cost reacts in the short run and in the long run. So let's talk about short run. So short run simply means at the beginning, when a business is just starting, perhaps the first day, the first week, the first month, the first year, basically. You all get that. So basically, short run means when a business is just starting. So in the short run, at least a factor is considered fixed. And since a factor is considered fixed, the cost incurred on such a factor will also be considered fixed. So in the short run, a firm is, a firm expansion basically is often being limited or constrained by a factor. So what it simply means, in terms of cost in the short run is that in the short run, when a business is just starting, at least a factor is considered fixed, and the cost incurred on such a factor is considered fixed. So, for example, let me just give an example. Let's say the fixed space which a business is using while it starts the business. That space, the rent that will be paid, the rent that will be paid on that fixed space. Don't forget, rent is a fixed cost. It's an example of fixed cost. So that rent will be fixed for over a period of time in the short run. While the business is in the short run, it will be fixed for over a period of time. So that's a good example of a kind of cost that is considered fixed in the short run. So cost of rent, cost of machine could also be considered fixed. That's basically capital and all that. But labor is considered variable factor of production. So that's with respect to short run. So short run explains that at least a cost is fixed in the short run. So it could be more than one cost, but basically at least one. Then in the long run means after a while, maybe a business has been in operation for, let's say, 5 years, 10 years, and all that. Then you can say such a business is in the long run. So in the long run, all costs are variable or are considered to be variable, because in the long run, a firm can decide to employ more labor, build more power plants, relocate its business, expand, contract, or exit the industry or in which the business operates. So what it means in the long run is that the firm can vary its various resources it employs into production. So because the firm can vary all the resources that are employed into production, then the cost incurred on each of those resources is considered variable. So in the long run, all costs are considered variable. But in the short run, at least a cost is considered fixed. And don't forget, in the short run, a firm's expansion is often being limited, constrained by a fixed factor of production, which could be land. Not could be land is a fixed factor, which is the fixed space the firm uses in its production. And the basic difference, let me just try and get to explain that once and for all. Let me just put it that way. The basic difference or the basic importance between this short run and long run is just the law of diminishing marginal returns. Diminishing marginal return applies when an increasing quantity of a variable factor is applied on a fixed factor. So that's when the law of diminishing return tends to apply. And the law of diminishing return, like I said, variable factor is being applied. An increasing quantity of variable factor is being applied on a fixed factor, then law of diminishing returns we apply. So law of diminishing returns only apply in the short run because at least a factor is considered fixed. But in the long run, don't forget all costs, all factors, the cost on them are considered variable. So let me try and explain the law of diminishing marginal returns once and for all. So the law of diminishing marginal returns now, let me explain that. So what the law states is that as more and more variable factor is increased or is combined on fixed factor, productivity will increase rapidly initially. Then it will at a time increases slowly. That's productivity will increase slowly. Then after a while, productivity will start decreasing. That means it will fall. And this is what we mean by that. Look at this. Because diminishing marginal returns, like I said, it's just talking about when you keep applying an increasing quantity of a variable factor on fixed factor, output will increase initially. Then it will increase a little bit, then after which it will start dropping. So this is the fixed factor. Let's say this is the fixed factor, the land. Because in the short run, most times, when a firm is faced with increase in the demand for its products, then how can the firm meet the increase in the demand for such? Perhaps by asking the workers to work overtime or employing more hands to work on that fixed perhaps space that the firm uses to produce. So here now we are saying this is the fixed space, and on this fixed space, which is land, 5 workers or 5 labor can only work here. So when you start producing, you employ 3 workers. That means there is a tendency for you to employ additional 2 labor here. So because there is an increase in the demand for your products, you need to increase supply of that product. Then you add 2 more labor, that's +2. Then as a result, productivity will increase rapidly. Now, there is a further increase in the demand for your products, then you need to meet that. Then you now went ahead by adding, let's say, additional to labor. Then what this means is that if you had these 2 additional labor, don't forget the number of workers that can work here, they are just 5. Then you have added more than enough labor. So that means here now, there are now 7 workers here or labor. So what this means is that all these workers here or labor will get in one another's way. And what that simply means is that the marginal productivity of each successive labor that is employed here will start decreasing. Then by that or consequently, you will have the marginal costs to start rising with the rise in the level of output. So what that diminishing marginal returns is just explains is that a case of, let's say, too many cooks spoil the broth, or most times we call it surplus capacity. Surplus capacity is when, as a firm, you've employed more than needed hands in the production of goods and services. And when that is the case, it will lead to inefficiency. All those workers will get in one another's way. And as a result, the marginal productivity of each worker that is employed will start dropping. And when the marginal productivity start dropping, then you say marginal diminishing marginal returns will set in. That means productivity will start dropping. Then as a result, you will have marginal costs to start rising. So when marginal cost starts rising, it means diminishing returns are setting. So that's with respect to the law of diminishing return. I state it again. Diminishing returns explains that as more and more quantity of a variable factor, which is labor, is increased or is, let me say is increased and combined on a fixed factor of production, output, productivity will, rise rapidly initially. That's in the short run. Then productivity will rise when you employ more labor. Productivity will rise slowly. That's at an increasing rate. But after you keep adding and adding, that means you've added excessive labor on fixed factor of production. Then in the long run, output productivity will start decreasing, and that means the marginal productivity of each worker will start reducing, and the effect of that on cost is that marginal cost will start rising, and that's as a result of inefficiency of all the workers. Too many cooks spoil the broth. That's basically what the law of diminishing marginal returns explain. If you employ more than needed labor in the production of goods and services, such will bring about inefficiency. And inefficiency will bring about fall in the level of marginal productivity, and marginal cost will start rising. That's that. So, having explained the law of diminishing marginal returns, then let's talk about the various classifications of costs that we have. So, come with me. Let's do justice to all this we have on the board. In a minute or thereabout, we're going to, be done with everything here. So, uh, come along with me. Let's do that together. So, uh, when we say cost, basically, like I've explained, the total cost of production that is incurred comprises elements of fixed and variable. So total cost, now let's start with total cost. So total cost is the total expenses incurred in the production of goods or services. So total cost is gotten by total fixed cost plus total variable cost, or average total cost times unit of output produced. So it's either you use this or this, you are going to get the same thing with respect to total cost. So examples of total cost, if you have total material cost, total labor cost, total rent cost, total fuel cost, total advertisement cost, total wages cost, and all that. That's with respect to total cost. Now, total cost will not often start from the origin. And the reason is just that because of the elements of the fixed cost that is often incurred, even when output is zero. So total fixed cost, even when output is zero, you will have to incur it. So total cost is not starting from the origin. And what that simply means is that when output is zero, total cost will not be zero because of the elements of the total fixed cost that is included in the total cost. Then it will not make total cost to be zero when output is zero. So when output is zero, total cost will not be zero. So here, when output is zero, total fixed cost is 3,000. Then when output is zero, total variable cost will be zero because you have produced nothing and you have purchased no raw materials, you have paid no labor and all that. So it will be zero. Then 3,000 plus zero, that gives us 3,000. So as output increases, total cost will also increase. And as output decreases, total cost will decrease. So I repeat, the reason you do not have total cost to be zero when output is zero is because of the elements of the fixed cost which you have in total cost. That's what makes total cost not to be equal to zero, and it makes it 3,000 here. So this 3,000 you have here when output is zero is the element of the fixed cost. That's that. So I hope that is understood. Good. So that's that with respect to total cost. So to get your total cost is the addition of total fixed cost plus total variable cost. So total fixed cost now. From the word fixed costs are those costs that do not vary with the level of output. It means they do not change with change in the level of output. That means irrespective of the change in the level of productivity or activity level, be it you are producing more or you are producing less, total fixed costs remain constant. So to get your total fixed cost is total cost minus total variable cost, or average fixed cost times units of output produced. You are going to get your total fixed cost. So like we did say, total fixed cost, even when production stops temporarily, that's for a short while, you are still going to expend money. You are still going to incur costs on total fixed costs or fixed costs generally. So examples of total fixed costs, we have rent, cost of rent, cost of renting an apartment, property tax, that's the tax you pay on property is fixed. Interest on loan, the loan you borrow from financial institution, the interest you pay on that, the agreement is always, uh, you know, intact. Let me put it that way. You can't change it. The bank will tell you this is the interest you're going to pay 5%, and it's going to be fixed. Depreciation allowance or charges. Uh, for the accounting student, the straight line method, equal amount is charged every year. So it's the same, it's fixed. Salary of permanent staff or managers is also considered fixed. Insurance premium, that's a regular sum you pay to the insurance company for guarding yourself against unforeseen events or circumstances. Perhaps you pay it every month, but basically every interval, it may be weeks, it may be monthly or yearly. It's considered fixed. So all these are examples of total fixed costs. So irrespective of the change in the level of activity, whether activity level rises or falls, whether it increases or decreases, total fixed cost is the same. It's going to be constant. They remain equal or unchanged. So when output is zero, total fixed cost is 3,000. Even though that's why I said, even though you stop production temporarily for a short while, or you shut down your factory for a while, you are still going to incur total fixed cost. And a good example here is rent. Then when you produce one, the same, you are going to pay 3,000. You produce two, three, four, it's 3,000. So total fixed cost is straight horizontal line, and it is parallel to the output axis. That's the x-axis. That's where you are. So total cost now, let's say total cost is 100 naira. Total fixed cost usually takes a larger proportion of the total cost. So here now, if total cost is 100, total fixed cost will take a larger proportion, 70. For most firms, basically, not for all firms, but for most firms, they will have total fixed cost to take a larger proportion of the total cost. So that's basically with respect to total fixed cost. So there are those costs that do not vary. They do not change with the level of output. And that's why most times they are often referred to as overheads, because they are above the usual cost of production. Whether you produce or you produce, whether you produce or you do not produce, you are going to incur total fixed costs. So total variable cost now. From the word variable cost, there are those costs that vary with the level of output. That means they change with the change in the level of output. So when you are producing more output, you tend to spend more total variable cost. And when you are producing less output, you tend to produce incur less total variable cost. So total variable costs, they have direct relationship with the level of or activity level or with the level of output. So when activity level is increasing, total variable cost will be increasing. And when activity level is decreasing, total variable cost will be decreasing. So to get your total variable cost, it is expressed as total cost minus total fixed cost, or average variable cost times units produced. And a good examples of total variable cost, we have wages costs, cost of raw materials, fuel costs, cost of advertisements, transportation costs, and all other costs that are variable with the level of activity, or that varies with the level of activity. So look at it here. Total variable cost is or starts from the origin. And what that simply means is that when output is zero, total variable cost will be zero. And as output increases, total variable cost also increases. So unlike fixed cost here, that is 3,000 when output is zero, total variable cost will also be zero. You can say start from the origin. When output is zero, when you have produced nothing, total variable cost will be zero. But as you start producing, or the more you produce, the more your total variable cost. It's just that for a firm to produce more, you have to incur more total variable cost. That's basically what that means. So total variable cost for most firms takes a smaller proportion of the total cost. So here, if total cost is 100, total fixed cost is 70, then total variable cost will be 30. So 70 plus 30 gives us 100, which is the total cost. So total cost is gotten by total fixed cost plus total variable cost. And total variable cost is total cost minus total fixed cost, or average variable cost times units produced. So that's that. So having talked about the various total cost curve, then let's talk about the various average cost curve, or average cost, or curves basically, yeah. So when we say average, average means per unit of output. That means the cost of producing 1 unit of output. That's average. So with respect to average cost, we are going to be looking at average total cost, average fixed cost, uh, average variable cost, and marginal cost as well. So average total cost now, it is the total cost per unit of output. That means the cost incurred by a firm in producing 1 unit of output. That's average total cost, which is the same thing as average cost. So average total cost is expressed as, or is defined as, total cost divided by unit of output, or average fixed cost plus average variable cost. Now let me explain something very important here. Average total cost is more or less total cost. It's just that total cost is for all the quantities of commodity produced, while average cost is just for one. So in this total cost, remember, there is an element of fixed and variable. Now, let me break it down further. If the total cost of producing 10 units of output, let's say the total cost of producing 10 units of output is 100. 10 units of output is 100. If we want to get the average total cost, that means we have total cost divided by units of output. So that means we have 100 divided by 10 units. Then that gives us 10 naira. So average cost is 10 naira. That's what we have. So in this average cost, which is the total cost of producing per unit of output, in this 10 naira, there is an element of fixed and variable components in it. So there is an element of fixed and variable. So variable and fixed. So let's say the fixed element is 7 naira, and the variable element is 3 naira. So the fixed element here is 7, then the variable element is 3. Then what you have here is going to be 10. So average total cost is 10. Then we've gotten that 10 by dividing 100 divided by 10. That gives us 10. Then this 10, which is average total cost, has been split into 7 and 3. So 7 is for the fixed element and 3 is for the variable element. So the fixed elements of the average total cost is average fixed cost. And the variable elements of the average total cost is average variable cost. So I hope you get the point that I'm trying to make here. Let me do a recap. The fixed elements of the average total cost, because in every total cost of producing 1 unit of output, there is always an element of fixed components and variable elements or components. So the fixed elements of the average total cost is average fixed cost, which we have here. Then the variable elements of the average total cost is average variable cost. So that's with respect to average total cost. Like I did say, it's the same thing as average cost. Then average fixed cost now. Average fixed cost also is the total fixed cost per unit of output. That means the total fixed cost you spend to produce 1 unit of output. So to get your average fixed cost, that's total fixed cost divided by units produced, or average total cost minus average variable cost. So here, we did say that the total fixed cost is 70 and the unit produced is 10. So here we can have, although we've expressed it here already, so average fixed cost is 7, is 7 here. Then average total cost is 10 minus 3, because average variable cost is 3. So 10 minus 3 gives us 7. So total fixed cost here we did say is 70 naira. Then divided by the units produced, which is 10 units. Then 70 divided by 10, that gives us 7, which we have here. So whichever way you go about using these of the or any of these two formulas or methods, you are going to get the same answer. Then last 6 now, sorry, 6, average variable cost. Average variable cost is the total variable cost per unit of output. So it is the total variable cost incurred or spent to produce per unit of output. That's average variable cost. So to get your average variable cost, that's total variable cost divided by units of output produced, or average total cost minus average fixed cost. So if our total variable cost is 30, that's 30 divided by 10 units, that gives us 3, which we've got in here. So average variable cost is 3 equals, then average total cost is 10. And we did say the average fixed cost is 7. So 7 minus 10 minus 7, that gives us 3. So average variable cost is 3, which we have. And if you want to go by total, that's 30 divided by 10. 30 divided by 10, that gives us 3. That's what we have. So this is for the various average cost curve. And we are going to be looking at the diagrammatical representation of all these average cost curves here. Then the last but not least, which is marginal cost. Marginal cost is, anytime you hear marginal in economics, it means additional. And marginal cost simply means the additional cost incurred to produce extra units of a commodity. Or most times it's often referred to as the last unit, the cost incurred to produce the last units of the commodity. But basically, the cost incurred to produce additional units or extra units of a commodity. And most times it is the cost that is added to the total cost for producing extra units of a commodity. Now, we did say here that the cost per unit is 10, and the total cost of producing that 10 unit is 100. So if we want to get our marginal cost, we can either use change in total cost divided by change in unit of output, or change in total variable cost divided by change in unit of output. So let's depict that here to see how we get our marginal cost. So this is what we have. We have quantity here. Quantity, we produce 10 units. Then the total cost of producing that is 100 naira. Then we want to produce additional, that's 11th unit. So it since average total cost of one is 10, then that means this will be 110. That's what we have. The cost per unit is 10. Don't forget, we produce 10 units for 100 naira. We produce 11 units. 100 units will be 110 naira. That's basically what we have. Then let's get the marginal cost now. So marginal cost, like we said, is change in total cost divided by change in quantity or units of output produced. So here, the change in total cost now, that's 110 minus 100. That gives us 10. Divided by 11 minus 10, that gives us 1. So 10 divided by 1, that gives us 10 naira. So this is the marginal cost of producing the 11th unit of output. So that's how you get a marginal cost. So whether you use this change in total cost divided by unit or change in the unit of output, or you use change in total variable cost divided by change in unit of output, you are going to get the same thing. The same thing. That's what you are going to get. Because the total cost curve and the total variable cost curve, they are just the same. Look at this. What you have here with respect to the slope of the total cost and the total variable cost, they are the same. The difference is just that total variable cost is starting from the origin and total cost is not starting from the origin. And the reason this is not starting from the origin, we did say because of the elements of the total fixed cost. So the slope of this total cost is exactly the same as that of the total variable cost. So whether you use total cost, change in total cost divided by change in unit of output, or change in total variable cost divided by change in unit of output, you are going to get the same answer for your marginal cost. That's that. So I hope that is understood. Good. So let's dissect the various average cost curve. Then let's begin with uh, average fixed cost. So average fixed cost, like I said, total fixed cost is constant in total. It remains equal in total. That means if the rent is 3,000, this is what we mean. If the rent is 3,000, quantity 1, 0, 1, 2, 3. Total fixed cost. If total fixed cost, the rent is 3,000, is constant in total. It's constant in total. That's 3,000 all through. This is what we have. So total fixed cost is constant in total, but varies per unit. And this is what we mean by varies per unit. Look at this. So let's say we have average fixed cost. Average fixed cost is the total fixed cost per unit. So it varies. Now to get our average fixed cost, don't forget average fixed cost is total fixed cost divided by unit of output. So you have 3,000 divided by 0. That's basically 3,000. 3,000 divided by 1, 3,000. 3,000 divided by 2, that's 1,500. That's 1,500. Then 3,000 divided by 3, that's 1,000. So the characteristics of average fixed cost is that it keeps falling. It falls continuously. And that is what we experience here in this graph. That's the slope. It keeps falling and falling and falling as output increases. So as output increases, average fixed cost falls or declines continuously. But it will continue to decline and decline, but it will never be equal to zero. That means it will neither touch this horizontal axis, neither will it touch the y-axis, but it will continue to fall continuously. And that's why most times average fixed cost is referred to as asymptotic curve or asymptotic. And asymptotic curve are those that doesn't touch either the y-axis nor does it touch the x-axis, but it will continue to fall like that. And the reason is just that if you continue to divide an increasing quantity by a fixed amount, the fixed amount is total fixed cost. You are dividing it by an increasing quantity, then the figure you are going to be having is continuous fall in average fixed cost. That's what you have. So it will continue to fall like that. So it is the only curve that doesn't have U shape among all the various average cost curve because it falls continuously. Then let's talk about the other ones. So average total cost, average variable cost, and marginal cost, they all have U shape. And the reason for that U shape can be explained using two ideas. That's economies of scale and diseconomies of scale, as well as diminishing returns. So I'll be explaining those 2 points here. Now, let me start off with economies of scale and diseconomies of scale. But before that, the various cost curves are U-shaped. That means they have U-shape. The first fall reaches a minimum, then they start rising. That's what we mean by they have U-shape. So the marginal cost cuts below the average total cost and average variable cost at their minimum points. That means the minimum point of average total cost is point A. Then the minimum point of average variable cost is point B. Then marginal cost cuts them below from their minimum points. Now, this marginal cost Both the average total cost and average variable cost, they exhibit the same characteristics, meaning that if marginal cost is below any of the two, then those two will decline towards it. That means they will fall towards it. And this is what you have. Look at this. When marginal cost is below average variable cost and average total cost, they fall towards it. They decline towards marginal cost. And at the same time also, when marginal cost is above the average total cost and average variable cost, they also rise, they increase towards it. So when marginal cost is above, average total cost rises towards the marginal cost, and average variable cost also rises towards the marginal cost. Now, you can see here that the average total cost starts falling, average variable cost starts falling. That is because when a firm becomes effective as it gets bigger, then we say such a firm is experiencing economies of scale. And when a firm is experiencing economies of scale, it means the firm is now operating on a large scale. And the result, the positive result of that is that the cost of production per unit will start reducing. And that is basically what you have. When the cost of production per unit or the cost of supplying per unit of an output start falling, it's beneficial for a firm. And that's why you see average total cost falling, average variable cost falling. But when a firm becomes less effective or efficient as it gets bigger, then you say such a firm is experiencing diseconomies of scale. And diseconomies of scale, you will tend to see it in a firm when the cost per unit starts rising. And here you can see that marginal cost, this is the minimum point of marginal cost, it starts rising. Average total cost also starts rising, and average variable cost also starts rising. And that is the effect of the fact that, or that is the result of the fact that the firm is experiencing diseconomies of scale. And diseconomies of scale simply means disadvantages which a business experiences, perhaps due to lack of coordination, or most times we did say here surplus capacity. Like I did say that one of the reasons why all these are U-shaped is because of the law of diminishing marginal returns. Diminishing marginal returns, when output starts increasing, you will have the firm to be operating on a large scale, and as a result, the cost per unit will start reducing, and that's why you have this. But after a while, when you've employed more than needed hands, that's surplus capacity, too many cooks spoil the broth, then all the workers will start getting in one another's way. And as a result, the marginal productivity of each successive worker that is employed into production will start reducing. And as a result, marginal cost will start rising. Average total cost will start rising, average variable cost will start rising, and you can see marginal cost rising as well. As output rises, marginal cost will also rise. So that's basically the reason why the various average cost curves have U-shape. I did explain uh, the reason for that is basically diminishing marginal returns as well as economies of scale. Economies of scale, I did say, is the advantages or benefits which a business enjoys due to its own firm or from other firms that are located within the same area. So when a firm becomes more efficient, more effective as it gets bigger, then such a firm will be enjoying economies of scale and cost per unit will be reducing. That's what you have. It will be reducing, reducing. But on the other hand, when a firm becomes so large, some bottlenecks will creep in, due to the fact that there will be lack of coordination, supervision, and all that. And with that, costs per unit will start rising, marginal cost will start rising, average variable cost will start rising, and all that. And that's the effect of the rising and the various average cost curve, as well as the law of diminishing marginal returns. So this is basically what we have for today's episode. I believe you all have learned a great deal with respect to the theory of cost. So, in our subsequent episode, we are going to be looking at practical questions on all this that we have put into our learning today or that we have learned today. So, you've just got to stay tuned for the next episode because we are going to be solving uh, questions in different dimensional ways they can be set as regards our theory of course. So at this juncture, I want to thank you all for your time. Uh, Thank you all for the support. Do like our videos. If you haven't subscribed to our YouTube channel, please do. And don't forget to ring the notification bell so that each time we release a video, you will get notified regarding that. And also, don't forget to continue to help share our videos to friends and relatives whom this video might be of tremendous help to them. And what more can I say? I wish you an excellent journey in your academics. You have a good one. I'll see you on my next video. Bye bye.